I think we're finally starting to have a more of a normal type of market, as it's not only the mega caps that are now going up, a lot of the value stocks, a lot of the REITs, and many others that I've been talking about are finally starting to catch up to the market. And I'm seeing it in my own portfolio. I'm seeing massive recoveries in a lot of the stocks, especially, some REITs that I own and many other things. So, things are, looking a little bit more normal, in the market. But this recovery from the October lows was nothing short of impressive, in my opinion. As you know, myself and most people on YouTube who were doing videos, bearish type of videos, although I was doing them from 2021 before most people were calling, for a crash. But most people were pretty bearish in 2022. And I said that we will likely have a big surprise in 2023, one side or the other. Either it's going to be much better than expected or much worse than expected, because we had one of the most anticipated recessions in history. And this is what happened. The market is recovering. We pretty much went above 4,300, which was a resistance line that a lot of bears were counting on, but we did close below it, which I believe it's not good. I mean, if we closed above 4,300, it would be more of a bullish, sign for the market. But one of the reasons why most of us were pretty bearish last year is because we were looking at indicators that would tell us when the market normally tends to, have most of its decline, or when does the market normally tend to bottom, which normally the market bottoms whenever the VIX hit 40. This time we didn't hit 40. The market normally bottoms after the Fed pivot. As you could see in this chart, most of the declines in 2000, in 2008, and even in March 2020, every time the Fed hikes rates, start a tightening cycle, we have a pretty much a correction, but the bigger correction comes after the Fed pivot, and this has not played out so far. In fact, the Fed is still hiking rates, and we're having a massive recovery, and this has pretty much confused everyone. And I think one of the reasons why this has actually happened that I talked about before, and it's mainly because there's so much money out there from the massive balance sheet expansion that happened in March 2020. You could see where the balance sheet was. It skyrocketed to $8.9 trillion. And now the Fed is, pulling out liquidity and it is reducing the balance sheet, but they still have a long way down to go before it makes any meaningful impact, in my opinion, on the markets, on our pretty much anything. But one of the reasons why we have those big moves to the upside or to the downside is mainly around investor sentiment and expectations. People were bearish in 2022. Something good happens or any kind of good news could cause massive moves to the upside. And the opposite is true. People were extremely bullish in 2021. They were buying their SPACs and GameStop and AMC. Well, anything that goes bearish or any kind of bad news is going to turn the sentiment to the opposite direction. Everyone's going to become bearish, and it's just we have another kind of cycle, another kind of correction. And this is a trend that's beginning that I would like to talk about and highlight in this video. I think this is something important to pay attention to if you're more of a trader, or if you're even an investor for the kind of companies that are actually in your portfolio. I think it's very important. But if we look at the AAII, sentiment kind of survey indicator, whatever you want to call it, it's pretty close to where it was in November of 2021. And if you look at the weekly change, we had massive changes in bullish sentiment this week, and it's as high as it was in November of 2020. And these bullish expectations and the rallies that we're having are actually causing the EPS estimate to start rising again. It was going down from 2022. It troughed so far in 2023, February or March, and as the rally continues, investors are getting more and more bullish, sentiment is getting more and more positive, and this is causing the EPS estimate to actually go up. But I believe there's only one thing that can actually, make this assumption wrong and change the entire sentiment from extremely bullish back to extremely bearish, extremely negative, and it's going to take some time. It's not going to happen overnight, and it's something that not a lot of people are talking about, and this is mainly around student loan repayments. And as you know, in the United States, we had the officials pass the debt ceiling type of bill, and inside the debt ceiling, it has something where over 40 million Americans with student loans will likely have their next due date in September. They're gonna have to start paying back those student loans in September. And this is a very big deal because we had student loan paused for 3 years in the United States. So people were taking this extra money that they have every month. They were buying Apple products, whatever, Apple Watch, whatever, things from Amazon, maybe some kind of services from Google or Netflix and all these other things. Well, now this is gone, and it's much harder to cut your spending than to increase your spending. So this is going to affect a lot of companies, a lot of cyclical companies, maybe cruise companies, maybe companies, that have more discretionary spending. Personally, I'm not worried about it because most of my companies are in necessity industries that people need and not just want, something you can't really cut back on. And this is going to affect a lot of those companies, and it's going to affect the EPS estimate, which is rising just because things are better than expected and the stock market is going up. And it's going to take some time to play out, but it's not going to be pretty for earnings for a certain type of companies which I'm not exposed to. But if you look at what the director of Student Borrowing Protection Center actually said, and he said resuming student loan payments without cancellation, which they can't cancel them, will lead to unprecedented delinquencies and default for most financially vulnerable borrowers because they have so much debt. The car loans, car prices are much higher, interest rates, they have now student loans, credit card debt is sitting at all-time high. So it's not going to be easy to manage at all. So if you combine that with the Fed's balance sheet that's likely going to continue decreasing going into 2024, we could potentially have what we're looking at in this chart where the Fed pivots in 2024 because things are very, very bad, not because things, are good, not a soft landing as you can see in this chart. And if that ever happens, maybe then the S&P can decline again. And this is where we could potentially have this play out again, because it has been very, very accurate from the 1970s that every time the Fed hikes rates, most of the decline happened after the Fed pivot, unless this time is different. This is the only scenario I can think of where student loans start putting a lot of stress on the economy while the Fed's balance sheet is playing out over a few months going into 2024. This is not something that's going to happen immediately, but in the meantime, people are calling for a new bull market because the S&P went up over 20% from the lows in 233 trading days. And based on some historical patterns, this has actually meant that the S&P has actually entered a new bull market after it entered a bear market, declining 25% in 282 days. And it's not something that I personally believe in or count on or anything like that, but it's just pretty interesting to me how it happened in 2008, 2009, March 2020, 2001, 1987. So it rose 20% from the lows. People are calling for a new bull market, but I believe not a lot of people are paying attention to the student loans, which could put a massive, stress on the economy, on a lot of earnings as well. But in the meantime, as I said, the market is going up. I don't know if we're going to break 4,300 or not, but I believe we will ultimately retest, the trend line that we got from March 2020 and the October lows. This is a very strong, trend line, which is why myself and the people in my own investment group, we're not opening any major short positions as long as we're above the trend line. I think it's a mistake to actually do it. It's better to wait for the market to correct, and then you could, kind of play it along if you want to, short it. It's not good to short something that's just going up without knowing the reason why it's gonna come down. This is why people lost money with Nvidia. They shorted it because it's going up and because it's expensive, but they never thought of what could potentially bring it down. And this is how you could lose money, shorting the index in a major way and shorting a lot of stocks. But if you actually look at the DAX, the German index is sitting at all-time high. So maybe this is where the S&P 500 is going in a short period of time. We don't know yet, but I believe there's a new trend that's starting to play out, and the catalyst could be the student loan repayment, what we actually could have a repeat of what happened pretty much 7 times, 6 to 7, around 7 times actually in history of every time the Fed hikes rates. We have most of the decline after the Fed pivot is going to be, remain to be determined. It's going to be interesting, to see what happened. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.